We are on homework 11, page 3. Okay, on this one, we're going to answer some questions. So we've got a note payable. The date of issuance is November 16th, 2020. The principal is $10,000. The term is 120 days, and the interest rate is 5%. On which date must the note be repaid? All right, so I'm going to go over here and say November, it's going to be outstanding for there's 30 days in November, minus it was issued on the 16th. So 14 days, and a total of 14 days by the end of November. In December, it's going to be outstanding for a whole 31 days because December has 31 days. And the total number of days outstanding as of the end of December will be 45. In January, it's going to be outstanding for another 31 days. And the total number of days outstanding as of the end of January will be 76. And in February, not a leap year in 2021, so that'll be 28 days. And it will be outstanding as of the end of February for $104 days. So in March, we only need another 16 days. So after on March 16th, our note will have been outstanding for 120 days. So we must repay this note on March 16th, 2021. Oh, it says that there. Let's go ahead and put that in. March 16th, 2021. All right. What is the total amount of interest to be repaid at maturity, round to the nearest dollar? All right, so it's going to be our principal of $10,000 times our interest rate of 5% times 120 divided by 360. 166, they said to round, so we're going to round to the nearest dollar, which is going to be $167. What is the total interest incurred as of 12/31? Okay, well, we said at 12/31, this note was going to be outstanding 45 days, or will have been. So we're going to multiply the principal times the interest rate times 45 divided by 360. That's going to give us $48. And again, we're going to follow the instructions and round to the nearest dollar, so $49. Prepare the journal entry to record the issuance of the note. So when we take out the note, we're going to get cash of $10,000, and we're going to credit notes payable for $10,000. Prepare the adjusting journal entry to record interest expense. Now it's an adjusting journal entry, which means we will not impact cash. We will impact one balance sheet account and one income statement account. We're going to start with the income statement account, and we're going to debit interest expense. And that will be for the interest that was accrued or that was incurred as of December 31st, which is $49. That was our income statement account. Now we have to do our balance sheet account, and we're going to call that interest payable for $49. Now it says prepare the journal entry to record the payoff at maturity. Okay, so we know first we're going to debit notes payable for the principal. And I'm going to debit interest payable for the amount of interest we've already accrued. And I'm going to zero out that account. I credited before, so I debit now. Now that account will be zero because we're going to actually pay the interest. And then I'm going to debit interest expense for the total amount of interest minus what we already accrued. 49, so it's going to be 118. 49 plus 118 is 167. Let's just make sure. That way we know we're doing it right. It is perfect. And then we're going to credit cash, and it's going to be the interest, the principal plus the interest we accrued at the end of the year, plus the 2021 interest, and that's going to be 10,167. And if I add it up, these numbers, that'll give me 10,167. So I know I did it right. All right, that wraps up page 3.